Swing Trading Suckers is the title of today's presentation. And while that might sound a little bit harsh, the truth of the matter is, if you're somebody that truly believes you can swing trade your way to wealth and keep that wealth, then you are indeed a sucker. The odds of that happening are next to zero, and that's what we're going to talk about today. We'll talk about what swing trading is and why it's such a bad idea. Now, you may have heard this term, being poor is expensive, and maybe the best example of that would be the payday loan franchises in the United States that advance you money that you need to pay your bills before you get your paycheck. The interest rates on these loans are absolutely ludicrous when you annualize them. So being poor is indeed expensive, especially when it comes to investing. And you need money to make money. And that's partially because the smaller the amount of money you're playing with, the more likely it is that you're going to take risks with it, the easier it becomes to take it from you. And you're always looking for the quick way to wealth when you're poor because wealth seems so far away. I know, I've been poor and I've made all the mistakes that we're going to talk about today. So I know very well what it's like to be poor and what it's like to want wealth. People without a plan will inevitably be led astray, and those who see swing trading as a potential plan should dismiss that very quickly because it's only going to cause pain. There are no shortcuts to getting wealthy. There's no free lunch. So let's talk about trading versus investing. We're going to talk about three types of trading. Day trading, that's when you move in and out of a stock in the same day. So day traders don't keep positions open overnight. Because stocks move relatively slowly, that typically means you need margin, which is leverage, loans in other words, to start to gear up your trades to make more money, which increases risk. Then you have swing trading. That's typically doing the same thing as a day trader does, which is speculating, except the time frame has changed from the same day, a 24-hour interval, to days and weeks. Then you have trend trading, which moves to weeks and months. Now, what's the difference between trading and investing? It's quite simple. You invest in companies and you trade stocks. The first activity, investing, is about finding quality companies, investing in those companies, and watching them grow over time, while trading is simply speculating on the movements of share prices. Even if you're someone who's an investor, the odds are still against you. So even if you realize how pointless trading is and you invest your own money, the odds are still against you because even professional investors, 95% of them can't beat a benchmark over the long term. So the whole notion of being able to trade your way to success is even more ludicrous. Now, swing trading versus day trading, this is a good example that emphasizes the durations and risks and talks a little bit here about capital requirements. So there's actually a rule, and I pulled this from Schwab here. It's called the pattern day trader rule, and they put this into effect after the tech bubble popped in the early 2000s, and it simply identifies day traders based on their activity. So if you make 4 more day trades, it's buying or selling the same security within a single day over the course of any 5 business days in a margin account, and those trades account for more than 6% of the total activity, your account will be flagged as a pattern day trader account, and then you need to have a minimum of $25,000 in that account. So this sort of helps prevent people from getting into day trading, but it doesn't prevent them from getting into swing trading. So people who want you to swing trade, they're usually selling some system. Now, anybody that's selling a system to become a successful trader is selling snake oil, because those who don't know tell everybody, and those who don't tell are the ones who know. Anybody that has a system that allows them to swing trade successfully isn't selling that system. The reason that these individuals have money in the first place, they'll lead you to believe it's because of their system. It's because they're selling systems to idiots. So those who are selling a system, or or a platform. When it comes to these platforms, they just want you to transact. So the more transactions you make, the more money they make. And of course, there are people who claim you're missing out, and eventually they will become miserable with their losses, and misery loves company. Now, you can see some firms will have a platform and a system that they're selling, and they all contain the same sort of rubbish about how you're going to be able to beat the market by identifying patterns and things like that. You actually have sites out there that are rating swing trading courses, and they talk about how a great swing trading course has great teachers, course quality, and budget. Essentially, these are affiliate sellers that are pushing all this crap down your throat. You'll see lots of different flashy websites, trade, travel. Here's one. Are you ready to start making money in the stock market? Supposedly, this individual has 12 to 16,000 students coming through the school at all times. These poor individuals are simply distracting themselves when they could actually be investing and starting to accumulate wealth. Now, let's just pretend that we're going to do a swing trade with Tesla to understand the psychology here. So first of all, you need to pick a direction. Because the stock market moves upwards over time, shorting is a very bad idea, and we published a piece on that. I'll put a link to that in the description of this video. So fine, you're going to go long Tesla. So when are you going to go long Tesla? Well, let's say that you picked the perfect point on the recent dip and bought at around $108 a share. Well, when do you close the trade? That's the big question. What's your price target or gain target, and why? So if you're investing in Tesla because you believe in the company at all, setting targets makes zero sense. Why? No company's potential will be realized in weeks or months. Try decades. And if you're doing things like, well, I'm going to speculate on whether or not they have a good or bad earnings, we see a lot of people doing that. You're just speculating. You might as well go to the casino and you'll have a whole lot more fun. And the technical analysis, tea leaves, won't help. All right. So this is an example of what would be called a technical trade. And I really studied this stuff. I really enjoyed it. I found it to be very interesting. Unfortunately, it isn't the way to accumulate wealth, but you're more than welcome to dabble and teach yourself about how technical analysis works, because it can be quite fun if you have the time for this sort of thing. So here's an example from Investopedia that shows a trade on Apple, and you have these notions of resistance and support, which are meaningful. They actually have some validity to them. You see the mention here of a stop loss, so that's a way to limit your losses, and this is just a trade that, of course, after the fact seems quite obvious, but it's never the case when you're watching the charts unfold in real time. So a lot of individuals will look at things like candlestick patterns. These are quite fun. I used to spend a lot of time poring over these. You have the inverted hammer. They have cool names, the bullish spinning top, and they're bullish and bearish candles, and these candles can be rendered over different periods of time. And it all sounds rather cool and interesting, but the truth of the matter is that being able to consistently over time beat the markets using a strategy that relies on technical analysis is next to impossible. And there's this myth of what's called a proprietary trader. So investment banks used to have these individuals that would actually trade on the bank's book. Here's the deal with trading. So I truly believe this. You're never going to be able to preserve wealth unless you had to work long and hard to create it. Windfall wealth is easy come, easy go. You can see this with lottery winners. So when somebody wins any sort of sum in the lottery, studies show there's a 3 to 5 times likelihood increase of them going bankrupt. Someone who accumulates millions of dollars through hard work over a long period of time isn't going to easily part with their money. So the more money that you have that you've accumulated slowly over time, the more risk averse you become, because you realize how difficult it is to accumulate money, how long that takes. And when you're poor, there's the temptation there of trying to accumulate it very quickly, as this individual did. This is a good article by The Guardian that I read, and it says how I turned $15,000 into $1.2 million during the pandemic, then lost it all. And the psychology being demonstrated here is just remarkable. This individual amasses this large sum of money, if what they said is indeed true. And how you can see that it is true is based on how they describe their psychology when that number starts going down. So when they get to 1.2 million, they've gotten such an ego, and it's impossible for them to lose money in the market. They're sending out these notes to everybody about all these plans they have and all the things that they're going to do. And now their ambitions are even bigger, instead of perhaps realizing that the likelihood of doing this is extremely, extremely small, and that this would be a good time to cut bait and stop fishing. But this individual then proceeds to lose it all, and at the end has $80,000 in taxes owed, $30,000 in their account, and is in the negative now and needs to probably get a real job. So one of the problems there is that when you manage to accumulate wealth very quickly, you'll quickly lose it. And his psychology when he got down to his last $250,000 was, well, I lost all that. I had that high watermark. The only thing I can do now is go big or go home. And that's just that. I mean, that psychology, you could just see how dreadful it must have been being this individual. You don't want to be this person. So when we look at, here's an article by Bloomberg, talks about retail traders, and then in the next sentence says refers to investment portfolios. Well, there's a difference there, and they need to distinguish that. But let's just call these people investors. It says retail investors lose $350 billion in brutal year for taking risks. So the average retail portfolio is down about 30% compared to the S&P 500 that's lost 17%. These people are probably, anybody that's doing trading, of course, accounts that are still open. There was a study done by Fidelity over time that what they tried to do is find their best performing retail accounts. Those ended up being the owners who forgot about their accounts or who died. So it's about time in the market, not timing the market. This other individual here could be that same individual who turned $15,000 into $1 million, though the names are different, told the New York Times, similar story. They make it so easy for people who don't know anything about stocks to invest. You go in there and you start to lose money. This individual, this is a classic, plans to appeal his case to financial regulators for arbitration. Good luck with that. And take some accountability for your poor decisions. And this individual here also told that similar story about how they had all these plans to invest their wealth. I think this person actually started spending the money and now owes a whole bunch. Now, when we look at the market and what's been happening lately, what's rather cool is that the bear market started almost exactly at the end of 2021. So you can simply look at January 1st, 2022 going forward to see losses for different vehicles. The S&P 500 down 14% since that date. NASDAQ down 23%. Anarch's fund, they're down nearly 60%. The arrow at the top there, that points to when the bear market started. The arrow to the left of that points to the temporary blip of when the pandemic hit and how the market reacted to that. We've always believed that the market should be able to test those previous lows, given the fact that the pandemic erased trillions of dollars in wealth, and that's never been accounted for. So it remains to be seen what the market does, but you should be very happy we're in a bear market because that's when it's a good time to start buying stocks. Now, you need to be careful about tech stocks, and we always talk about buying quality. Well, how can a quality company like Invitae, for example, right? Whether or not Invitae is a quality company is irrelevant, but let's say that you believed it was. How can this stock be down 93%? Well, that's because tech and growth stocks are a very risky domain because future growth is priced in. And when the likelihood of that future growth starts to evaporate, that gap closes, that value disappears, and suddenly a stock can be down 80 or 90%. You see that happening in a number of positions, no matter how careful you are. Inevitably, when you're investing in tech stocks, some will blow up. For value companies, such a gap doesn't exist. So you can see the difference there between growth and value. It's highly unlikely you'd ever see an S&P 500 firm lose 93% in 2 years. So there's only two reasons that we'd sell stocks. Going back to this idea of swing trading. So you enter into a position of a company that you like. When do you sell it? Well, you sell it for tech stocks, at least our rules. You have to have some rules, come up with something. Our rule is that if growth stalls, and of course, how long is a piece of string, but we gauge that based on each individual position. If growth stalls or our thesis changes, that's when we sell a tech stock. As for our dividend growth investing portfolio that represents value, there's there's only one reason that we sell a stock in that portfolio. It's because dividend growth stops. Now, what's important that you do is stop thinking about day trading or swing trading or any other sort of trading. Start educating yourself about how to become a successful investor. Because the easier it is to make money, the quicker you'll lose it. The way to become a successful investor is not very quickly. So roughly half of all money inherited is saved. The other half is spent or lost investing. So people that come by money very easily are likely to lose it, which we all probably, most of us stand to inherit something when our parents die. So it's probably a good idea to start learning about investing, because this old adage, shirt sleeves to shirt sleeves in 3 generations, refers to the fact that most generational wealth gets lost because of a lack of financial education. So you owe it to future generations to educate yourself on how to become a successful investor. And that's what we do here at Nanalyze. Now, I wanted to touch briefly on my own life as a trader. I started getting into trading when I discovered nanotechnology several decades ago. I remember buying and selling a stock multiple times in a single day. I had absolutely no conviction. That's when I learned about day trading patterns. I looked at automating Forex trading strategies. So I worked in a lot of startups, and when I had some spare time, it wasn't when the market was open, and Forex markets were open 24/7. So I started looking at how I could leverage my ability to sling code into an automated strategy. And I put something together with play money, and then when it went to real money, everything went to shit. So that's how it is. You may have all sorts of beginner's luck when you start trading, whether that's with a fake money. Usually more likely you'll have luck with fake money. When it gets to real money, suddenly psychology comes into play, and that beginner's luck will eventually go away. I read all the recommended reads, and then I did an MBA, and I wanted to be a trader on Wall Street. So I knocked doors in most of the buildings you see in this picture. This is Canary Wharf in London. And what ended up happening, I met plenty of traders. I didn't get a job in trading. I did get a job in risk management, which started in the summer of 2007. And anybody who works in finance knows what happened in the summer of 2007. That's when the 2008 financial crisis started. So it all happened to work out. Certainly a lot of luck there. And I only started accumulating wealth when I stopped trading. So if you want to be a big swinging dick trader, here's what you should do. Read this book, Reminiscences of a Stock Operator. All right. It's written in the 20s, and the lessons in that book are still valid today. Build your own system. Nobody's going to sell you a system that works. Don't get involved in shorting, margins, or options. Allocate no more than 10% of your wealth to your newfound strategy. Invest the remaining capital in index funds or quality companies. Give it a year and see how much money you made from trading. Now, bull markets made bad habits. So some of the people watching this video have probably already had their asses handed to them. Now is the time to become a better investor. So you can subscribe to our newsletter. That's what we do here at Nanalyze. We teach people how to become better investors, and you can subscribe to our YouTube channel as well. Now, our own wealth is tied up in various asset classes that you can see here. We did a piece called Investing in 2023. I'm going to put a link to that at the end of this video, and you should probably watch that next. And it talks about this idea of breaking down your assets into categories such as safe, riskier, and alternative. We've done that here. You can see where our money is allocated. Quantigence is our dividend growth investing strategy. Nanalyze represents our tech stocks. And then we have funds, some cash, and of course, alternative assets. You can see that nearly 80% of the wealth that we've accumulated, the assets that we're managing, sit in safe investments. So just to conclude, the best way forward is to forget about trading, day, swing, trend, or otherwise. Start developing the mindset of an investor. And if you're going to procreate, pass that mindset on so you don't go from shirt sleeves to shirt sleeves in 3 generations. The truth of the matter is, what nobody wants to tell you, becoming wealthy is a long, slow, boring process. And I've put up another video here for you to watch. Before you watch that video, please click the Nanalyze logo here on the right. Subscribe to our channel. Thanks for taking the time to watch this today.